Profitable trading is not built on finding perfect entries. It is built on understanding the mathematics behind your decisions. Without these 4 essential principles, even a strong strategy and high-quality setups may fail to produce consistent results. In this video, I will explain 4 mathematical principles that influence long-term trading success, followed by one important question that could completely reshape the way you trade. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. I want to open with 5 statements that may change how you understand trading. Most traders, and possibly many of you, spend too much time searching for the perfect entry. But a genuine trading edge is not created by one flawless setup. It is created through probability, repetition, and mathematical advantage. The outcome of any single trade is uncertain and can feel similar to a coin toss. What determines long-term success is not one isolated win or loss, but the statistical performance of your trading system across a large number of trades. That is why one trade by itself proves absolutely nothing. Now look at this chart. It shows how traders often divide their attention across different areas. Strategy receives the largest share at 40%. Indicators and psychology each receive 20%, while risk management receives 12%. Expectancy receives only 8%, even though it is the measurement that reveals whether a trading system can actually produce a profit over time. This is where the imbalance becomes clear. Traders dedicate most of their energy to searching for strategies, adjusting indicators, and improving their psychological control, but they spend very little time studying the mathematics behind the system. So, the problem is not necessarily a lack of effort. It is that the effort is being directed toward the wrong areas. That is why some traders can spend years studying the market and still remain stuck. So, let us begin with part 1, expectancy, and understand what actually determines whether a trading system makes money over the long run. Expectancy is the single most important number in trading. It has nothing to do with your last trade, how clean your recent setups looked, or how confident you felt when you placed them. Expectancy measures the average amount your system is expected to make or lose every time you execute a trade. Now look at the formula on the screen. It combines 4 variables: your win rate, your average winning trade, your loss rate, and your average losing trade. Together, these 4 numbers tell you whether your strategy has a mathematical edge. If the final result is positive, your system has positive expectancy. If it is negative, no amount of discipline or confidence will make that system profitable over time. The examples below illustrate this perfectly. The first system wins only 15% of its trades, which sounds terrible at first. But because the average winning trade is much larger than the average losing trade, the overall expectancy remains positive. In other words, even after losing most of its trades, that system can still make money over a large sample. Now compare that with the second example. Here, the win rate is much higher, while the reward-to-risk ratio is smaller. Yet the mathematical expectancy is still positive, and in this case even stronger than the first system. The third example follows the same principle. This strategy wins most of its trades, but because each winner is relatively small, the overall expectancy ends up being surprisingly close to the first example. That is the key lesson. A profitable trading system is not defined by a high win rate or by a large reward-to-risk ratio alone. It is the relationship between those 2 variables that creates a statistical edge. Once you understand that relationship, you stop chasing impressive numbers and start focusing on what actually makes a system profitable. Now, why is expectancy so important? Because it reduces the performance of your entire trading system to one measurable result. Instead of relying on a vague belief that a strategy should work, you can evaluate how much that system is expected to produce per trade across a sufficiently large sample. That is the difference between opinion and evidence. When expectancy is positive, the strategy has the mathematical potential to generate a profit over time. But that number only becomes useful when it reflects the conditions you actually face in the market. This is where many traders make a mistake. The expectancy calculated on paper is not always the expectancy you will achieve in real trading, because every position includes costs. Spreads, commissions, and slippage reduce the amount you keep from winning trades and increase the impact of losing trades. As a result, a system may appear profitable during a basic calculation but become unprofitable once those costs are included. That is why realistic expectancy must account for every expense involved in executing the strategy. Now, let us examine why so many traders quit too early. Look at this graph. It represents two systems moving in opposite directions over a sample of 100 trades. One has positive expectancy and gradually moves higher, while the other has negative expectancy and continues moving lower. The important point is that the difference is not always obvious at the beginning. During the first 10 or 20 trades, both systems remain close to the starting point. The results are still too limited, so you cannot confidently determine whether the strategy is profitable or unprofitable. As the number of trades increases, the underlying expectancy begins to reveal itself. The profitable system separates to the upside, while the unprofitable system moves progressively lower. By the time the sample approaches 100 trades, the contrast becomes much clearer. This is why judging a strategy after only a few trades can be dangerous. A valid system may begin with losses or show very little progress before its statistical advantage becomes visible. If you abandon it too early, you may walk away from a genuine edge simply because you did not give the mathematics enough time to work. Remember this idea because it connects directly to variance, which we will examine later in the video. Now this brings us to part 2, system design. How do you build a profitable trading system? The answer begins with accepting a trade-off that many traders spend years trying to avoid. There is no perfect strategy. Every system gives you something, but it also requires you to give something up. A larger reward usually comes with a lower win rate, while a higher win rate usually comes with a smaller average reward. That is not a weakness in the strategy. It is simply how probability works in trading. This is where many traders get stuck. They keep searching for a system that delivers an extremely high win rate and an extremely large reward at the same time. But that combination is rarely realistic, and the search for it often leads to constant strategy changes instead of consistent execution. Now look at this chart. It compares 4 different systems using expectancy per trade. The 8R system wins only 15% of the time and produces an expectancy of about $350 per trade. The 6R system wins 30% of the time and produces about $1,100 per trade. The 3R system, with a 55% win rate, produces the strongest result at around $1,250 per trade. Meanwhile, the 1R system wins 70% of the time but produces only about $400 per trade. The important point is that these systems reach positive expectancy through very different combinations of win rate and reward. A system can win rarely and still make money because the winners are large. Another can win often and still produce less because the average reward is small. So the edge does not come from one number alone. It comes from the balance between how often you win and how much you make when you do. Now let's talk about what I like to call the sweet spot. Look at this chart. It illustrates one of the biggest trade-offs in trading. As your reward to risk ratio increases, your win rate naturally tends to decrease. That is not because the strategy stopped working. It is simply because larger profit targets are harder for the market to reach. Think about it this way. If your target is only 1R, price does not have to travel very far, so your win rate can be relatively high. But as you increase that target to 3R, 5R, or even 10R, price has to make a much larger move before you can take profits. Naturally, those trades will succeed less often. That is why the best opportunities are usually found somewhere in the middle. Not because the middle is a magical number, but because it often provides the best balance between reward and probability. You are not relying on an extremely high win rate, and you are not depending on unrealistic price moves either. Many traders make the mistake of chasing one extreme or the other. Some want to win almost every trade, so they settle for very small targets. Others chase enormous reward-to-risk ratios, but end up sitting through long losing streaks that become emotionally difficult to follow. The goal is not to maximize your win rate or your reward-to-risk ratio independently. The goal is to find a balance that produces positive expectancy and, just as importantly, one that you can execute consistently over hundreds of trades. Once again, this is where mathematics and reality meet. The best system is not necessarily the most exciting one, and it is not always the strategy with the most impressive backtest. The best system is the one you can execute consistently across hundreds of trades without abandoning the rules when results become difficult. Now look at this chart. It combines win rate and reward to risk ratio to show where stronger expectancy can be found. The darker area represents combinations with greater mathematical potential, but the extreme upper right corner would require both a very high win rate and a very large reward. In real trading, achieving both at the same time is usually unrealistic. A more practical sweet spot is found closer to the middle of the chart, where the system still has strong mathematical potential but remains possible to execute. A 40% win rate with a 4R average reward can produce a powerful edge. A 50% win rate with an average reward of 3R or 4R can also generate excellent results. The goal is to improve gradually by moving towards stronger combinations of win rate and reward while remaining realistic about what your strategy can actually achieve. You do not need the darkest point on the chart, and you do not need to win nearly every trade. You need a positive combination that can be repeated consistently over a large sample. This brings us to the break-even formula, which tells you the minimum win rate your system needs based on the reward you are targeting. The formula is simple. Divide 1 by your reward, multiple plus 1. The result gives you the win rate required to finish at break-even before trading costs. Now, look at the table. With a 1R target, you need to win 50% of your trades just to break even. At 2R, the required win rate falls to approximately 33%. At 3R, it drops to 25%, and with a 4R target, you only need a 20% win rate to avoid losing money over time. To become profitable, your actual win rate must remain above that break-even level after accounting for spreads, commissions, and slippage. So, with a 4R target, winning slightly more than 20% of your trades can already produce positive expectancy. Think about what that means. You could lose close to 80% of your trades and still have a profitable system, provided that your average winners consistently reach 4R and your losses remain limited to 1R. Once again, the goal is not to be right most of the time. The goal is to make enough when you are right to compensate for the trades that lose. Now, let us move into part 3. Variance, and understand why traders often fail emotionally even when they are doing everything correctly. Variance changes the sequence of wins and losses, which means the same profitable system can create completely different short-term experiences for different traders. Now, look at these 3 equity curves. All 3 are based on the same strategy, the same rules, and the same expectancy. However, the results do not develop in the same way. One trader experiences relatively smooth growth from the beginning. Another moves higher more gradually, while the third goes through a deeper drawdown before eventually recovering. The important point is that all 3 traders may be executing the exact same system correctly. The difference comes from the order in which the winning and losing trades occur. One trader may receive several winners early, while another may experience a cluster of losses before the system begins producing positive results. Now, imagine being the trader who experiences the deepest drawdown. Even though the strategy still has positive expectancy, you may begin questioning the rules, searching for a different system, or wondering whether your edge has disappeared. Meanwhile, another trader using the same strategy may be seeing steady growth and feeling completely confident. That is why variance is so difficult emotionally. The short-term path can look very different even when the long-term mathematics is the same. That is variance, and it leads to one of the hardest truths to accept in trading. You can make the right decision, follow your process correctly, and still lose. A valid entry, a properly placed stop loss, a realistic target, and perfect execution do not guarantee that any individual trade will succeed. You may follow your trading plan exactly and still lose 7 trades in a row. At the same time, another trader may ignore every rule, take poor quality setups, and win 5 trades consecutively. That is dangerous because a short winning streak can reward bad behavior and create the illusion that the decisions were correct. This is why short-term outcomes do not tell the full story. A few wins do not prove that a system is good, and a few losses do not prove that it is broken. Only a sufficiently large sample can reveal whether the strategy has a genuine edge. The same principle applies to expectancy. One individual trade means almost nothing, and a very small group of trades is still not enough to judge the system with confidence. Now, this is where your mind can begin working against you. After 1 loss, then 2, and eventually 4 or 5 losses in a row, you may start feeling that the next trade is more likely to win simply because the losing streak has continued for so long. This mistaken belief is known as the gambler's fallacy. Now, look at the chart. It shows how a trader's perceived probability of winning may rise after each consecutive loss. After 4 losses, the trader may feel that the next setup has an 82.5% chance of winning. After 5 losses, that perceived probability may rise above 90%. But those numbers represent what the trader begins to believe, not what is actually happening mathematically. That false confidence can lead to dangerous decisions. You may increase your position size, risk more than usual, or accept a weaker setup because you believe the next trade must recover the previous losses. But a losing streak does not create an obligation for the market to give you a winner. Each new trade must still be evaluated according to the probability and expectancy of your system. If your strategy has a 50% win rate, the next valid trade remains close to that same probability, regardless of whether the previous 5 trades won or lost. More generally, the probability remains connected to your system's edge, not to the recent sequence of outcomes. So, be very careful after a losing streak. The next trade does not become more likely to win simply because several losses came before it. Past outcomes may affect your emotions, but they do not automatically change the probability of the next independent trade. Now, we arrive at part 4, risk. None of the mathematics we have discussed will matter if you do not survive long enough for your edge to produce results. This is why position sizing is where discipline becomes visible in practical terms. Each trade may require a different stop-loss distance, but the amount you risk should remain consistent. A wider stop-loss requires a smaller position size, while a tighter stop-loss allows for a larger position size. The distance changes, the lot size changes, but the amount at risk should stay controlled. This is why risk per trade matters so much. If you risk too much, even a normal losing streak can place the entire account in danger. But when the risk is small enough, you give the strategy enough room to move through variance and allow the edge to work over time. A practical risk range is between 0.25% and 2% per trade, with 2% as the maximum. Keeping risk within that range helps prevent one difficult week or one bad month from causing damage that becomes too difficult to recover from. Now, let us focus on one of the most practical parts of risk management, position sizing. A position size calculator allows you to convert your chosen percentage risk and stop-loss distance into the correct trade size, so you are not relying on guesswork. Now, look at the calculator on the screen. The account is denominated in US dollars, with a balance of $1,000 and a risk limit of 0.5%. This means the maximum amount that can be lost if the stop loss is reached is $5. For this EUR/USD trade, the stop loss is placed 25 pips away from the entry. Once those values are entered, the calculator determines that the appropriate position is 2,000 units, which is equivalent to 0.02 standard lots. So instead of choosing the lot size first, you define the amount you are willing to risk, place the stop loss according to the setup, and then calculate the position size that connects those two decisions. Even a severe losing streak can remain temporary when the system has a valid edge and the risk is controlled. The losing streak itself is not always the greatest danger. The real danger is using a position size that allows that sequence of losses to cause permanent damage. When risk is managed correctly, a drawdown can still be uncomfortable, but the account remains capable of surviving it. The balance may decline for a period, but enough capital remains for the trader to continue following the system when conditions improve. If the risk per trade is too large, however, the same sequence of losses can produce a completely different outcome. Instead of experiencing a manageable drawdown, the trader may lose so much capital that recovery becomes extremely difficult or even impossible. That is why risk must be calculated before the trade is opened. The objective is not to prevent every drawdown, because drawdowns are part of trading. The objective is to make sure that a normal losing streak does not remove you from the market before the system has an opportunity to recover and allow its positive expectancy to appear. Now, let us look at the risk of ruin, which in this case represents the probability of losing 50% of the account. Look at the chart. When the risk per trade is kept at 0.5%, the probability of reaching that level of drawdown is close to 0. At 1% risk, it remains very low, at around 1%. But once the risk increases, the numbers change quickly. At 2% risk per trade, the probability of losing half of the account rises to approximately 18%. At 5% risk, it jumps to about 65%. That difference is enormous. Increasing the risk from 1% to 5% does not simply make the account grow or decline 5 times faster. It changes the probability of severe damage in a much more aggressive way. This is not an opinion, and it is not only a question of psychology. It is basic mathematics. Once you understand that, you begin to understand why survival must come before profit. A trading edge only has value when your risk is small enough to keep you in the market long enough for that edge to work. Now, losses and gains are not equal, and this is another area where the mathematics can work against you. A 10% loss requires an 11% gain to recover, not another 10%. As the drawdown becomes larger, the recovery required becomes increasingly difficult. For example, after losing 30% of the account, you need to gain approximately 43% on the remaining capital just to return to the original balance. If the account falls by 50%, you then need a 100% gain to recover. In other words, once half of the capital is gone, the remaining balance must double simply to get back to where you started. This is why protecting capital matters so much. Avoiding deep drawdowns is not only about reducing emotional pressure, it also prevents the recovery process from becoming mathematically much harder. Now, after everything we have covered, we arrive at one final question. What changes from this point forward, and what should you do differently? Be completely honest with yourself, because the answer may involve the mathematics of your system, your psychology, or another part of your trading process. What is the one thing you already know you are doing wrong that, if corrected, could completely change your trading? You probably already have an idea of what it is, and if you examine your behavior honestly, the answer may become even clearer. Maybe you are judging a strategy after only a few trades. Maybe you are risking too much because you are searching for excitement instead of executing objectively. Maybe you are confusing a profitable outcome with a good decision, abandoning your edge when variance appears, or searching for certainty in a business built on probabilities. Your answer may be one of these, or it may be something completely different. You can share it in the comments so other traders can reflect on their own behavior as well. Whatever your answer is, the path forward remains the same. Think in probabilities instead of judging isolated outcomes. Evaluate your edge across a large sample of trades, because that is what allows the mathematics to work in your favor. Keep your risk small enough to survive variance, understand that consistency matters more than perfection, and remember that your responsibility is to execute the plan, not to predict every result. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Calm Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Calm Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.